The first KPI we want to speak about is the gross profit margin. The gross profit margin is the amount left over after subtracting the cost of goods or services sold from the sales amount. And that contributes towards our expenses and our net profit figure. So here we have an example where sales are 10,000 and the cost of goods sold is 6,000. When we subtract those from each other, we have 4,000 left over. That 4,000 divided by the $10,000 in sales multiplied by 100 gives us 40% or 40 cents in the dollar. This means that for every sale, we are left over with 40 cents, which goes towards the paying off expenses such as overheads and other variable costs, and towards giving us a net profit figure. The second KPI we need to consider is return on investment. This measures the success on a particular action that we have taken. Consider, for example, marketing campaign. What we're going to look at now is how to calculate the return on investment. Say we had sales of 15,000 and marketing of 5,000. We subtract those from each other to give us $10,000. Now what we do is we divide that 10,000 by the $5,000 of marketing expense and multiply it by 100, giving us a return on investment of 200%. What this means is that for every dollar of marketing expense we incur, we expect to receive twice that amount back. What we need to focus on now is increasing that return on investment percentage to say 300% or 400%. The higher, the better. And it means that our marketing expenses are really working hard for us to generate the sales, which will later help us to become more profitable. The third KPI you want to pay close attention to and monitor carefully is the accounts receivable turnover. This measures how frequently we are paid by customers and clients to whom we sell on credit to. To determine this KPI, we divide the yearly credit sales or any sales for a given period by the average accounts receivable for that particular period, whether it's a year or a month, which gives us the number of times the clients or the customers pay us. The higher this number, the better. And to get this number to be higher, we either increase our sales or decrease our accounts receivable balance that's owed to us at any given period. The fourth KPI we want to keep a close eye on is the inventory turnover KPI. This tells us how frequently or how often we sell our product. The more times we sell our product, the better it is for us. It means that it's not sitting in a warehouse or somewhere where it's collecting dust, and it's solving our customers or clients' pain points. So how do we calculate the inventory turnover? Well, we take the cost of goods sold at a given period and divide it by the closing average stock for that given period. In this example, we have 200,000 divided by 30,000, which gives us 3.4 times. The higher this figure, the better it is for us. It means that we are getting our stock out there and we don't have stock obsolescence issues. Now, if we do identify that we have stock obsolescence issues, we need to deal with that stock. Potentially, we have a fire sale where we dispose of it and take that money and place it into stock that is moving, that is solving our customers' problems. The fifth and last key performance indicator we want to have a look at is the operating cash flow ratio. And the operating cash flow ratio looks at how much our current liabilities are and how often we can repay those liabilities using our operating cash flow. The higher the number, or the more times we can pay off our short-term liabilities, the better it is for us. It just means that we are in a safe position to cover our debts. How do we calculate the operating cash flow ratio? We take our operating cash flow for a given period. In this example, we have 50,000, and we divide that by our current liabilities, in this example of 30,000. That gives us 1.67 times. Again, the higher that number is, or that times is, the better. With that said, what we don't want to have is too much cash hanging around. We want to put that cash into other locations or into other assets which will yield us more profit. The other thing we want to do is potentially move that cash into another organization to shield it from potential creditors or lawsuits or something like that within the bounds of the law. Thank you so much for watching this video. We hope it's been of enormous value to you or someone in your network. Please consider subscribing, liking this video, and turning the notifications bell on so you don't miss the next video and you're notified as soon as it comes out. Let us know what your thoughts are of this video. Let us know what your favorite KPIs are in the comment section, as well as potentially providing us with other topics and other things to cover in the future. Till the next video, keep safe.